Mmpc014. Today we are discussing Block 1. If we observe any business organization, small or big, we find people doing different activities in it. These people are carrying out various activities like managing the activities related to manufacturing of goods or providing services, managing the people involved in various works of the organization, selling different products that are manufactured or the services being offered by the organization, or arranging and making available required financial resources for carrying out the activities of the firm. All these activities are managed by a couple of people in a small business organization and by differently specialized people in large organizations. In big organizations, these activities are divided into different functional departments called the production department, human resource department, marketing department, and finance department. Finance is the lifeblood of any business and one of common denominator required for all the varied business activities. It must be sufficient to meet the requirements of the company. One needs outstanding financial management skills to start or run a successful firm. Nature of finance function. The main goal of any business firm is to make a profit. For this purpose, it invests money in a variety of income generating assets sourced from various sources. As a result, the finance function is aimed at the following decisions: to determine the funds requirement, to determine the assets to be acquired or fund deployed, to determine the pattern of financing the assets. The finance function can be broadly stated as follows. Routine functions. Routine functions do not require managerial ability of high order. These functions are supervision of cash receipts and cash payments, supervision of securities, etc. Managerial functions, they require the managerial requirements of the high order. Actually, this is our subject matter. Approaches of financial management. Financial management is the study of the process of producing and wisely using financial resources to improve the value of a company and consequently its shareholders. There are two different approaches to financial management: traditional approach and modern approach. According to the traditional approach, financial management is a discrete field of study and its scope is confined to money raising. As a result, the traditional approach to finance was restricted to businesses obtaining funds to fulfill their financial requirements. The subject was known as corporate finance until the mid-1950s. Since the primary focus of the finance function at that time was on the acquisition of funds. Following the 1950s, a combination of economic and environmental factors, including technical developments, industrialization, fierce competition, government involvement, and population growth, needed efficient and effective financial resource management. This financial resource management is actually the present subject, management finance. In this case, management must prioritize the most efficient use of the company's resources. With the new approach, the focus has shifted from episodic finance to managerial finance difficulties and from fundraising to efficient and effective fund management. Financial decisions. Finance responsibilities are critical in corporate management, regardless of the kind, size, age, or structure of the company. A business finance function is the link between the value of a commercial enterprise and its many variables. The value of a company enterprise to its owner is its net worth. Net worth means assets minus liabilities. When a company's net worth rises, it can be assumed that the company's value is increasing. The investment, financial condition, and profit distribution of a corporation define its value. Means as a formula, value equal to the combination of I, F, D. I here stands for investment, F finance, and D dividend. The corporation's financial activities can be separated into three key decisions: investment, financing, and dividend. Each of these choices must be considered against the firm's goal. The optimal combination of the three will maximize the value of the stock to its owners. Objectives of the firm. The company is a form of business in which ownership and management are separate. The shareholders are the owners, and the board of directors is the shareholders' representative to manage the company. Different decisions are made by the management team that has an impact on the company's profitability and long-term viability. When these strategic decisions are made, what should the firm's goal be? It is the central question, and the answer of value creation always results in financial gain for owners. However, there is disagreement over how to maximize the economic advantage to the owners. The two most well-known and often discussed criteria in this regard are profit maximization and wealth maximization. Profit maximization. According to this idea, actions that increase the firm's profit are adopted. while actions that reduce profit are avoided. The company's purpose should be to maximize profit. But this idea has certain limitations. The first one is ambiguity. Ambiguity of the word profit itself. What is the profit? Is it total profit or percentage of profit? Is it after tax profit or before tax profit? Is it return on equity or is it return on capital employed? Means there is ambiguity in the term profit itself. It ignores the timing of benefits. Suppose there is a company in which in the first year there is 1 lakh profit, in the second year there is 2 lakh profits, in the third year there is 3 lakh profits. If we take the average of these 3 years, the average profit will be 2 lakh. And there is another company B whose first year profit is 3 lakh, second year profit is 2 lakh, third year profit is 1 lakh. Again the average is 2 lakh. But the two companies are different. In case of B company, the maximum profit will be in the first year. While in case of A company, the maximum profit will be in the third year. The third limitation is it ignores the quality of benefits. An alternative to profit maximization, which addresses these issues, is the wealth maximization objective. Wealth maximization. The firm's most widely accepted goal is to maximize the value of the company for its shareholders. According to the wealth maximization goal, managers should strive to maximize the present value of firm's expected profits. The wealth maximization criteria's second aspect is that it considers both the amount and quality aspect of benefits, as well as the time value of money. It is undeniable that the goal of wealth maximization is superior to the goal of profit maximization. Risk-return trade-off. The firm's financial decisions are interlinked, and therefore they influence the market value of its shares by impacting return and risk. The following is a formula for expressing the relationship between return and risk. Return equal to risk-free rate plus risk premium. The risk-free rate is the compensation for the time that the investors part with their saving. Proxy for risk-free rate is generally the return earned on government securities of similar tenure. The risk premium is paid for risk coverage. A healthy balance between return and risk should be maintained to optimize the market value of the firm's shares. A risk-return trade-off is a term used to describe such a balance. Financial goals and firm's objectives. A question may emerge in the shareholders' wealth maximization criteria. Is the firm's goal to maximize its wealth? Is there a company that exists solely to serve the interest of its owners? Organization in practice define their vision or mission in terms of technology, leadership, market share, image, employee welfare, and so on. The management serves as both an agent for the owners as well as a trustee for the other stakeholders. As a result, the management must balance the interests of the owners with those of creditors, employees, the government, society, and so on. Time value of money. You must have heard a rupee today is worth more than a rupee tomorrow. Do you know why is it so? You could invest present 1 rupee in the market and earn a return on this amount. Rupee 1 at the end of a future period will have less purchasing power due to inflation. The time value of money concept will unravel the mystery of such choices that all of us face in our daily lives. Future value. Future value is the current assets at a future date based on an assumed rate of growth. The future value is important to investors and financial planners as they use it to estimate how much an investment made today will be worth in the future. Knowing the future value enables investors to make sound investment decisions based on their anticipated needs. There are two types of future value calculations. Number one, the future value of a lump sum is the value of a single deposit like a bank fixed deposit over time. And number two, the future value of annuity is the value of a series of payments like payment of insurance premium at regular intervals over time. The term annuity refers to a series of payments of constant amount. Now, practical calculation of future value. First one, using simple annual interest. If an investment earns simple interest, then the future value formula is future value equal to principal multiplied by 1 plus rate into time. This is actually a simple formula of simple interest. We have got the formula for simple interest, amount equal to principal into 1 plus rate into time. The same formula is here. For example, assume a rupees 1,000 investment is held for 5 years in a savings account with 10% simple interest paid annually. In this case, the future value of the rupees 1,000 initial investment is rupees 1,000 multiplied by 1 plus rate, which is 0.10, multiplied by time, which is 5 years. And the answer will be rupees 1,500. Now the calculation of future value using compound annual interest. With simple interest, it is assumed that the interest rate is earned only on the initial investment. With compounded interest, the rate is applied to each period's cumulative account balance. In the example above, the first year of investment earns 10% of rupees 1000, that is rupees 100 in interest. The following year, however, the account total is rupees 1100 rather than rupees 1000. So to calculate compounded interest, the 10% interest rate is applied to the full balance for second year, that is 10% of rupees 1100, or earnings will be rupees 110. The formula for the future value of investment earning compounding interest is future value equal to principal amount multiplied by 1 plus interest rate raised to number of years. Again here, this formula is the formula of compound interest. In case of compound interest, we have got amount which has become here future value multiplied by principal. Principal is again here principal multiplied by 1 plus rate raised to time. Future value of annuity. A common use of future value is planning for a financial goal, such as funding a retirement savings plan. Future value is used to calculate what you need to save and invest each year at a given rate of interest to achieve that goal. In general terms, the future value of an annuity is given as the following formula. Future value of annuity equal to A. A means constant periodic flows multiplied by 1 plus R raised to N. R is interest rate and N is duration of annuity minus 1 and whole divided by rate. Example, if you contribute rupees 2400 every year to a retirement account and want to calculate what that account will be worth in 30 years, you could use the future value of an annuity formula. For this example, you assume a 7% annual rate of return. Future value will be rupees 2400 multiplied by 1 plus rate of return is 0.07 raised to time, that is 30 years, minus 1 and whole divided by 0.7. That is rupees 2400 multiplied by the calculation of this 1 plus 0.07 raised to 30 is 7.612. You can do it with the help of calculator, or even tables are there from where you can find it out. Minus 1 whole divided by 0.7, or rupees 2400 multiplied by 94.461, that is 2,26,000 2,706. Means over 30 years, you would contribute a total of rupees 72,000. But because of the time value of money and the power of compounding interest, your account would be worth rupees 2,26,706 with an annual 7% rate of return, or more than 3 times the amount you invested. Present value versus future value. We can also measure the present value of money which is going to be received in future. Using it, you can calculate the worth of something today when you know its value in the future. This process is also referred to as discounting, because for any positive rate of return, the present value will be less than what it is worth in the future. The interest rate used to calculate the present value of a future return, cash flow, is called the discount rate. To illustrate present value, let's take an example. The future value of rupees 1,000 deposited for 1 year into an account earning an annual 2% interest rate is rupees 1,020. The formula we have already discussed. Future value equal to 1,000 multiplied by 1 plus 0.02 raised to 1, that is rupees 1,020. We also know that the present value of that rupees 1,020 is rupees 1,000, because it's what we started with. Or you may say now, present value is the mirror image of future value. Usage of present value. Some common uses for present value include calculating the value of pension annuity payments versus taking a lump sum, determining whether a business owner's investment will meet profit expectations, valuing a business, time value of money and its significance. The time value of money is very important to all for financial planning, from the decision you make to buy or lease an asset to a financial decision to investment in new equipment. The future value determines the effect of time on money. Using future value and other measures can help you make sound financial decisions. Calculation of time value of money. The time value of money can be calculated in 2 ways. The following formula can be used to calculate the present value of future cash flow. Mark it. All these formulas which are used here, they are based on the formulas for interest calculation. Present value equal to future value multiplied by 1 plus R. R is interest rate, raised to the power n, number of periods, or future value equal to present value multiplied by 1 plus R raised to n. Effect of compounding. The number of compounding periods used in time value of money estimates can have a significant impact. If the number of compounding periods is raised to quarterly, monthly, or daily, the concluding future value calculation will differ. We have taken one example here. Rupees 10,000 at 10% per annum. If we take annual basis, then it will be 10,000 plus interest 1,000, that is rupees 11,000. If we compound it quarterly, future value will be rupees 10,000 multiplied by 1 plus 2.5%, means 10% divided by 4 raised to 4 multiplied by 1, the answer will be rupees 11,038. Monthly compounding, future value will be rupees 10,000 into 1 plus 10% divided by 12, because here there are 12 installments, raised to the power 12 multiplied by 1, and the answer will be rupees 11,047. Daily compounding, future value will be rupees 10,000 multiplied by 1 plus 10% divided by 365, the number of days in a year, raised to 365 multiplied by 1, the answer will be rupees 11,052. You may see the difference. If it is compounded annually, 10,000 will be only 11,000. Compounded quarterly, it will be 11,038. Compounded monthly, it will be 11,047. Compounded daily, it will be 11,052. This demonstrates that the time value of money is determined not just by the interest rate and time horizon, but also by the number of times the compounding computation are performed each year. The time worth of money is a key concept in determining net present value, compound annual growth rate, CAGR, internal rate of return, IRR, and other financial calculations. Financial decisions, time value of money. The discounted cash flow analysis, which is one of the most common and prominent approaches for appraising investment proposals, is based on the time value of money. It is also a necessary component of financial planning and risk management. It would be quite difficult to find a single key sector of finance that is not touched by the time value of money in some way. First one is investment decision. Investment decision involves current cash outlay for an expected stream of cash inflows in the future. For example, investment in a machine. Financing decision. When a business, the financing decision is actually finding out the source for the investment which we have made. As I have given you example, investment in machine. From where the machine will be financed, this is financing decision. When a business issues a debenture, it receives immediate cash flow. At the end of each year, interest payments cash outflows are due. The debenture amount is redeemed after the period. These cash flows cannot be compared because they occur at separate times. Funding the discounted value means present value of interest payments and the redemption value is used to calculate the time value of payment. Means we will calculate the present value of interest payments and also the present value of final payment. And the total of these two will be compared with the present outflow. The present value of cash outflow is compared to the debenture selling value and a decision is made on whether to issue a debenture or not. Investment risk. The term risk is commonly used in the investment sector. In everyday life, the word risk frequently connotes an unexpected negative outcome. When you say it is risk to drive on a certain route, you are implying that driving on that route could result in an accident. The term risk in the context of investment, on the other hand, has a different meaning. It not only denotes the possibility of a negative outcome, but also the likelihood of a less positive outcome. As you are aware, risk and return are interrelated. A person purchases a financial assets with the intent of receiving a profit. The investment decision would be based on anticipated return, which may be realized or not. The risk associated with an investment decision is the possibility of an unexpected negative or adverse return. Sources of risk. The risk associated with an investment is always a concern for an investor. He is confronted with several inquiries. To comprehend risk, she or he needs to be aware of the following. Number one, what makes investment risky? Number two, what are the various elements or sources of risk that the investments are exposed to? Various types of risk. Market risk. Even though the company's earnings do not change, market price of investment, particularly equity shares, may fluctuate in a short period. You will see in the share market, prices change in every minute, or you may say in every second. The causes for this pricing change could be several. The market price of equity shares are affected by a variety of social, political, economic, and firm-specific events. Another aspect that influences market prices is market psychology. Interest rate risk. The interest rate influences the return on securities in a variety of ways. Because investors always compare risk-free return with expected return on investment. It has an impact on the expected or required rate of return. Inflation risk. Inflation risk is the variability in the total purchasing power of an asset. It arises from the rising general price level. If the money rate of return is equal to the rate of inflation, the investor obtains a zero rate of return. The risk of inflation originates from the uncertainty of the purchasing power of the money to be gained from future investment. Business risk. Business enterprises work in a constantly changing environment, which makes expected income to fluctuate. A change in government policy on fertilizer subsidies, for example, could harm a group of fertilizer companies. Similarly, a competitor's conduct, whether domestic or foreign, might have an impact on other businesses. It might be difficult to determine if a company risk is systematic or not. Financial risk. When the company capital structure includes debt, financial risk occurs. That creates a fixed liability which increases the income variability available to equity stockholders, and it is not always a negative thing. It will boost profitability when the company performs well, and stock investors receive a higher return than would otherwise be available. Management risk. Management risk is the portion of total return variability caused by managerial actions in companies where the owners are not the managers. Regardless of how experienced the management team is, there is always the risk of making a mistake or making the wrong decision. Management errors are the primary causes of management risk, component of overall investors' risk. Liquidity risk. The inability of seller to sell assets without offering price reductions and commissions is known as liquidity risk. It is simple to rate assets based on their liquidity. Due to lack of liquidity, investors are forced to sell securities at a lower price than the current price, especially when the quantity to be sold is significant. Therefore, when choosing securities, investor must consider the liquidity risk also. Social or regulatory risk. The social or regulatory risk emerges when an otherwise successful venture is harmed by unfavorable legislation. A harsh regulatory environment, or in the worst case scenario, nationalization by a socialist government. Price controls may lower the revenue of industrial enterprises, and rent controls may largely eliminate the value of rental property. The social risk is essentially political and thus unpredictable. But no industry can expect to be immune to it under a representative democracy based on rising government interference in corporate matters. Other risks. The monetary value risk and the political environment risk are two further categories of risk, particularly when investing in foreign assets. When investing in international securities rather than domestic securities, the investor should carefully consider the higher risk associated with international investment against the projected return, which could be in the form of interest, dividend, or capital gains. Types of risk. The risk may be classified into systematic and unsystematic risk. Systematic risk. The portion of return variability induced by factors impacting all enterprises is referred to as systematic risk. Or you may say economic risk of economy or of industry. Unsystematic risk. The unsystematic risk is the variation in the return of investment owing to factors that are specific to the firm and not to the market as a whole. Total risk is equal to systematic risk plus non-systematic risk because the two components are additive. Measuring of historical returns. The total returns on investment for a given period is cash payment received during the year, you may say dividend, plus price change over the period, means difference in the big prices in the beginning and prices at the end. The whole divided by price of investment in the beginning. Measuring expected return and risk. We have just looked at historical return and risk so far. Now we will discuss the predicted return and risk. For that, first you have to see the probability distribution. When you buy a stock, you understand that the return on your investment might be anything. For example, it could be 5%, 15%, or even 35%. Furthermore, the probability of these possible returns may vary. As a result, you should consider probability distributions. The likelihood of an event's occurrence is represented by its probability. Expected rate of return. The expected rate of return is the weighted average of all possible returns multiplied by their respective probabilities. In symbols, expected rate of return equal to summation of RI, return from stock under state I, PI, probability that the state I occurs, and number of possible states of the world. Number 3 is standard deviation of return. The dispersion of a variable is referred to as risk. The variance or standard deviation are usually used to calculate it. The sum of the squares of the deviations of actual returns from the expected return weighted by the related probabilities is the variance of probability distribution. In terms of symbols, variance or standard deviation square is the summation of P1, probability associated with the ith possible outcome, Ri, return for the ith possible outcome, ER, expected return. Valuation of securities. The goal of a valuation is to figure out how much a company's equity or net operating assets are worth. Any valuation considers the current value of some future flow, such as dividend, cash flow to stockholders or shareholders, free cash flow, abnormal earnings, or abnormal operating income. The future is divided into two parts: an explicit forecasting period during which the analyst calculates the present value of flow generated by a set of projected financial statements derived from the prospective analysis, and a post-horizon period during which the analyst makes a simplifying assumption about the future's growth. Need for valuation. Because business valuation is so important, a business owner or individual may need to know how much his company is worth. various expression of values. Fair market value means the value at which property would change hands or ownership is fair market value. Book value, net worth. In case of net worth, assets are reported at historical cost, while liabilities are reported at face value. Intrinsic value, the value of security such as stocks that is estimated based on all facts and circumstances of the business or investment. Replacement value, current cost of acquiring a comparable new property. And liquidation value is the net amount that can be realized if the firm is shut down and the assets are liquidated. Business valuation approach. Accurate valuation necessitates the proper application of existing methodology to value determination. The following are the three types of business valuation approaches: income approach, market approach, and assets approach. Income approach. The income business valuation technique is based on the concept of valuing future benefits in their present value. The two most common methodologies are earning capitalization method and number two, discounted cash flow method. Market approach is the concept of determining a company's value by comparing it to the market value of similar publicly traded enterprises. Assets method is founded on the substitution principle. Investment decisions are based on the required rate of return. First, we have to find out what is the required rate of return, and on that basis, the investment decision will be made. Three-step valuation process. The first one is top-down three-step strategy, and the second one is the bottom-up stock valuation. Top-down three-step strategy depends upon the analysis of economy, analysis of industry, and analysis of company. While bottom-up strategy thinks that regardless of the market, it is possible to uncover stocks that deliver greater returns as compared to industry outlook. In economy analysis, we analyze larger system, the whole general economy. Means, for example, fiscal policy, political uncertainty, war, etc. Industry analysis, changes in the economy do not affect all industries equally, and business cycles do not affect all industries at the same time. Therefore, it is necessary to do the industry analysis. Company analysis, an investor can study and compare the performance of individual businesses within the industry after evaluating the industry's forecast, which is positive. General valuation framework. Again, it is the same formula. Present value equal to cash flow. Cash flow includes interest, dividend, earnings, etc. of first period divided by 1 plus r. Cash flow of the second period divided by 1 plus r raised to 2. Cash flow of third period divided by 1 plus r raised to 3, and so on to the infinity. Value price relationship. The price is determined by present value, often known as inherent value or economic worth. When value outweighs the price, time to buy. When the value is less than price, time to sell. When the both values are equal, do not trade. By now, you should be aware of the dynamic nature of valuation, estimates of present value, riskiness, discount rates, future income, buy, sell. Valuation of fixed income securities or debt securities issued by government and quasi-government or private businesses. How is it calculated? Valuation of preference shares. The same formula. The value of perpetuity today is constant annual payment divided by 1 plus the required rate of return appropriate for the perpetuity. This will be for every period and total will be known as the value of perpetuity today. Valuation of equity share. The preference shares and equity shares, they are different. In case of equity shares, obligation is neither specified as in case of preference shares and not perfectly known in advance as in case of bonds and debentures. Second main important point is that dividends, cash flows, earnings are utilized as an alternative measures. Dividend valuation model. In terms of future dividend, there are three scenarios. Dividends do not grow in future, or you may say zero growth assumption. Dividends grow at constant rate. You may say constant growth assumption. Dividends grow at varying rates in future periods, that is multiple growth assumption. PE, profit earning approach to equity valuation. The PE methodology, unlike the dividend capitalization model, is relatively straightforward and commonly used in the stock market. The price earning model is a far more straightforward and practical valuation methodology. The stock price is calculated using this methodology as the product of predicting earnings and the stock's regulated PE ratio. In the next block, in the next counseling, which will be on 13th of this month, we shall discuss block 2 of MPCC 14. That's all. Namaskar. हाँ, block 2 बोल दिया।